The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The busiest week for earnings arrives as investor angst over politics grows. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Bonnie Quinn, and we are counting you down to the closing bell here in the United States. Let's take a look at where we stand, because could we be getting a repeat of last week? It wouldn't be the worst thing in the world, right? We had a down day on Monday, remember? And that was followed by 3 up days for the week. Entirely pleasing to investors. If you look right now, we have the S&P 500 well off its session lows, down about 1/3%. The Nasdaq 100 only down about 0.5%. We were down more than 1% for most of the session. The 2-year yield has been moving. Look at that, a 6 to 7 basis point move. Investors getting just a little nervous again. We are seeing some steepening, and this time it's because of the front end. And the VIX index, I wanted to point this out because last Monday we were at 34. We have come down a long way from where we were, but still, you know, in a normal environment, this would be considered elevated, Romaine.
Yeah, an interesting setup to start the week, a sell-off to kick off what is going to be the busiest week for earnings all season long. That includes reports from Meta, Amazon, Microsoft, Apple, a fifth of the S&P 500's weighting. And the stakes, they've rarely been this high. Valuations still elevated despite a $5 trillion market plunge amid the trade war, and analyst estimates for profit growth, well, those have yet to adjust lower. That's going to complicate things, and so too is a complication of the calculus with regards to the debate over whether U.S. market exceptionalism is indeed in peril. Now, we've been here before with pundits predicting demise without necessarily addressing the relativeness of U.S. dominance, because if it's not the dollar, if it's not treasuries, if it's not the S&P, then where do investors turn? In a few minutes, we're going to talk to the European Economy Commissioner and get his thoughts on whether the trade bloc is in a position to actually capitalize on America's perceived weakness. Now, some investors, though, they already think they know that answer. Citigroup strategists say growth companies in the NASDAQ 100 are still a safer place to take shelter. Morgan Stanley Mike Wilson says the weak dollar, that it might actually help U.S. markets outperform. And Seema Shah over at Principal says while investors are looking for non-U.S. alternatives in the short term, in the long term, no one is putting real money yet behind the idea that the U.S. will lose its crown.
It's a combination of the US looking a little bit more concerning, but also the attempts by a lot of governments to reshore their economies. We're hearing more and more of these headlines. So it does mean that from an international perspective, there are more opportunities, and I think that is starting to play through. But it doesn't necessarily mean that investors are going to be aggressively moving away from the US. It's just that the world is a bigger place.
And that was Seema Shah on Bloomberg Television a little bit earlier today. As we kick you off to the close, right now with Angela Mwanza, private advisor and managing director with the Rockefeller Global Family Office. Great to see you, Angela.
Always good to see you.
There's been a big debate, as you know, about reallocating away from U.S. assets into, I guess, anything else, whether it's Europe, Asia, or wherever. Have you seen a meaningful push in that direction, or is that just all anecdotal?
I think we've been seeing or hearing a lot of questions from our clients specifically around that issue. I don't think we're of that camp. I don't think it's leave the U.S. The U.S. is still the dominant market. It still encapsulates probably 70% of the MSCI All-Country World Index. So you're not going to get away from that. What I think is interesting, though, is when we have opportunities and dislocations like this, it's a chance to be able to reallocate assets out of the U.S. and into international, because U.S. has outperformed international for the last decade, and it's looking kind of attractive. And from a timing standpoint, it's at a lower valuation. And so short to intermediate term, I think we should get some good upside from international stocks.
We've kind of been down this road before in the past, where a lot of people said that we'll enter a new cycle where non-U.S. assets outperform. And that's usually been relatively short-lived. Right. What's different this time? Is there a real structural change? Are you seeing that? Or maybe this will be a much longer cycle of rotation?
Huge structural change that we're seeing, which is triggering a lot of clients to ask, has the US dollar lost its dominance? Yeah. I don't think that's the case, and I don't think that's our view. But we are seeing central banks diversify out of the US dollar. And with the trade tariffs going on, there is not a company in the world that's not looking and thinking about their supply chain and where are they sourcing the components and materials from. And how can they diversify their access? I think this bodes well for economies within Europe, at least developed international.
Yeah, what is the next part of the trade narrative? What is the market waiting for? Are we waiting for a bilateral deal with one big country? Are we waiting for supply chains to start grinding to a halt?
I absolutely wish that's what we were going to get. I think at this point, we're just going to be a little bit more humble in our desires. We're going to really look towards where is there progress? Where do we see that these conversations are actually leading to some sort of outcome that is going to be mutually beneficial? I think if we see that, the market is going to feel a lot more comfortable and stability may be on the horizon. Until then, we're going to stay in this limbo of uncertainty and insecurity around what is going to happen next within markets.
Angela, is there a commodities trade here, whether it be raw earths that we will have access to if there is that kind of component in a trade deal, or raw earths that we won't get any access to, thereby, hurting production in the US?
I mean, at this point, I think your guess is as good as mine. There's just no certainty. We don't know what that looks like. What we can do, though, is be proactive around where do we want to invest? And that's a question that clients are asking us, which is, okay, well, we know what we can't do right now, but what are opportunities for us to do? And for us, we try not to have be happy when markets are up or sad when markets are down. We work very closely with clients to understand what is their risk objective. And so for us, when we have this conversation, we're saying, okay, well, let's add a little bit of tactical defensiveness. Let's put some consumer staples. Let's add some healthcare. We've got some tailwinds with an aging population. There's great innovation in the healthcare space, health tech. It's one of those absolute essentials. So we're going to do a little bit of a tilt over there. And private markets, I think private markets are a really interesting place. You talk about commodities. I think within infrastructure, I think within private markets, we're trying to find those inflation adjusted, so to have the same sort of component like a commodity investment, but also with some sort of cash flow component to it as well. That way we get a win-win on the inflation hedge as well as investment.
On that last point, how hard is it to find those opportunities right now? Because I know on one side, on the other side of that trade, you have a lot of private equity and private capital firms that are eager to see new money come in from new sources. And then you have people like yourselves who seem to be looking for that. Is there a matchup?
There can be a matchup. I think what's the challenge with private equity, there's always a lag to their performance reporting, to their mark-to-market. So we want to be able to get a better sense on what their solid footing is. But I think it's really in that idiosyncratic, more boutique area of private markets where we're looking, whether it's in the credit side or the equity side. Everything, for instance, private real estate. There's certain parts of private real estate that have insulated themselves from the risk of inflation. So if inflation hits, their rent rolls are going to go up. And so that bodes well for our investments.
I know you are kind of the ultimate of kind of long-term investors. And of course, we talk a lot on the show about the short-term moves. As you kind of put the short-term moves together with what the long-term looks like, are you hopeful? Are you fearful when you look at all the changes going on here in the U.S. and ultimately what's going to reverberate around the world should what's happened over the last 3 months continue for another 3 months or even 3 years?
I tend to be a glass half full, even though I know sometimes that's not always the most practical. Ultimately, I do think that as corporations have a sense of their capital allocation, have a sense of what their supply chains are going to look like, that's going to give us directionality. So I believe in the strength of corporations. There's not a company out there that isn't taking a look and saying, how do I model out what my outcome is going to be, regardless of what happens with the tariff wars? So what's the best case? What's the worst case scenario? I feel like I'm back in business school doing all those regression analyses, but that's what they're doing. And I think that's where we're waiting to see, and we're waiting for the data to be able to make smart decisions within the short term, but also for the long-term impacts.
But the funny thing is now all that education pays off. Remember, we went through a bull market cycle where it almost didn't matter. You just throw a dart at the board.
It's
and
like
now
60-40, fine. All the alternatives, everything we did didn't help, but yes.
All right, well, absolutely. Now time's to shine. Angela Mwanza, one of the best in the business, a private advisor and managing director with the Rockefeller Global Family Office, kicking us off to the close on this Monday afternoon with the focus on policy and trade tensions. Those trade tensions and, well, how much they will hurt or maybe even benefit other countries across the globe. Coming up, a conversation with Valdis Dombrovskis, the EU Commissioner for Economy and Productivity. He's going to be joining the program in just a bit.
And speaking of trade tensions, a look at how they could impact America's supply chain, specifically trucking companies, with a Morgan Stanley analyst who just upgraded one stock in that space.
And how is the trade war impacting Hollywood? We're going to have a conversation with the CEO of IMAX. Their results came out last week, and that's on the heels of a relatively strong international box office this weekend. Richard Gelfond joining us later in the show. Stick around. This is The Close on Bloomberg.
President Donald Trump set to mark his 100th day in office this week, with his last month in office marked by back-and-forth trade policies that have roiled Wall Street. And should this trade war persist, particularly with China, the US could experience a significant supply chain jolt, with the CEO of logistics company Flexport estimating last week that cargo bookings from China to the US have fallen by 60% since tariffs took effect. I want to bring in Shawn Donnan with Bloomberg News to discuss this more in depth with us. So, Shawn, it does seem like we're in a stalemate period, at least with China. China is sort of sitting back and letting the US, as analysts have been saying, negotiate with itself. What breaks this cycle? Is it a deal with another country?
Potentially, but look, the news on that front is so far that the kind of deal flow is pretty slow, if you will. The president and the White House have promised these kind of rapid deals. They've touted the number of countries that are lining up to strike deals. But the fact is, the issues that they want to talk about are complicated. They're going to take time. These aren't things that aren't going to be resolved in a matter of days. And meanwhile, you have this kind of economic impact, which is starting to be felt.
So give me a sense here, Shawn. I mean, we talk about this idea of all these countries allegedly lining up. There's been a lot of talk about who was first in the queue, whether it was the South Koreans or the Japanese or somewhere in there. Is that your general sense of how this is going to play out? That the priority won't necessarily be on what the existing trading relationship or the size of the economy is going to be basically about who called the president first?
Well, look, I think what's really interesting here is that none of the three top trading partners of the United States, that's China, Canada, and Mexico, are lined up to talk deals here. One, Canada, obviously there's an election going on there today, so just exactly who is going to be engaging with the U.S. Is unclear. Same on Mexico's side. There is a bigger trade agreement that President Trump wants to negotiate with Canada and Mexico, the USMCA, what used to be known as NAFTA, and we should expect something on that down the pike. China, they can't even agree on whether they're talking or not. Beijing saying very clearly that they're not. The president here saying that there are talks going on, so we really don't know what's happening there. And that leaves this kind of these other families of countries, Japan, the European Union, South Korea, Vietnam, countries like Indonesia, all very keen to talk. But really, we should also remember that these are kind of initial talks in a lot of ways. A lot of those countries just want to figure out what exactly President Trump wants from them and what they might get in return.
Shawn, you can use lots of different numbers. You know, we know that Walmart receives about 50% of its stock from China, basically. We know that Amazon, 70% is sourced in China, whether it's sellers or Amazon itself. But for China, there's another number, and that's that it's 3% of its GDP, which sounds small. So who has the leverage here, really?
Well, look, I think there's disagreement on who has the leverage. If you talk to Scott Bessent, the U.S. Treasury Secretary, or other people in the administration, they insist that the U.S. has the leverage because China exports a lot more to the U.S. Than the U.S. sends back in the other direction. But there's another way of looking at it, which is that the U.S. depends on those imports in a big way as well. You have to remember that 40%, something like that, of the imports that come from China here into the U.S. are essentially components and other intermediate goods that are relied on by manufacturers here. You're thinking about car parts, you're thinking about semiconductors, you're thinking about circuit boards, the things that go into the production lines here in the United States. So if those stop, and right now with 145% tariff on anything coming from China, that's pretty prohibitive, and we see a lot of trade slowing down. That's going to result in a pretty severe economic impact here in the United States, as a lot of those factories, at the very least, slow down.
Well, that's what I'm curious about, as to whether the administration has articulated sort of a plan to do this, because we talk about the supply chain structure as if it was something that just cropped up overnight. I mean, that was decades in the making, and I assume replacing it with something different, at least at minimum, is going to be years in the making, Shawn. Are we going to be able to weather the potential economic damage in the interim? You had a Dallas Fed survey today that showed manufacturing activity dropping. There's been a lot of anecdotal evidence, a lot of photographs circling the internet right now showing just how empty some of our key ports are. And of course, you have retailers and other folks that sell goods that have basically said, look, whatever we have in inventory, that's pretty much it for the year until this is all over.
Yeah, look, I mean, if you talk to companies, they'll tell you they have 3 months of inventory or something like that. And then once they run through that, there's going to be empty shelves, or they're going to be forced to shut down production in some cases. And that's a pretty common number that I've heard from companies that I talk to. So I think the whole point to remember is we've seen the kind of turmoil in financial markets in recent weeks. We haven't really seen the economic impact yet. What we've seen is survey data, and that economic's coming down the pike pretty quickly. And that's why we see the big box stores and others talking about a summer of empty shelves, some real supply shocks this summer. And those are goods that need to be on the water now. If they're not on the water now, they're not going to be on those shelves 6 weeks from now.
Yeah, it's kind of interesting too, Shawn. We remember a few years ago, we were all talking about the gap between the survey data and the real economic data, that vibe session, if you will. But of course, this time it could be different. Of course, we get a big GDP report this Wednesday, the first big read at the first quarter number. Shawn Donnan, who helps to cover everything trade and supply chain for us here at Bloomberg, as our coverage continues here on this Monday afternoon. A focus on one aspect of that supply chain, and that is the trucking space. Ravi Shanker, managing director over at Morgan Stanley, is going to talk about his upgrade of the less-than-truckload company Saia. That conversation when we come back after our break and top calls right here on The Close on Bloomberg. All right, time now for our top calls. Big movers on the back of analyst recommendations. And we start off today with Jack in the Box, Vonnie's favorite. Stifel upgrading the fast food burger chain to buy with a $32 price target. That actually implies about a 30% upside over the next 12 months. The Stifel analyst says the new CEO has created a viable plan to strengthen the balance sheet. And you're seeing those shares up for a second straight day. Up next, Eli Lilly, HSBC double downgrading the drug maker to a sell equivalent rating from buy, slashing the price target to 700 from more than 1,100. The analyst says the market is pricing in too much optimism around the company's market share gains and the adoption curve for GLP weight loss drugs. The share is down about 1% on the day. And lastly, let's take a look at Saia. This is a trucking company. It specializes in smaller hauls of manufacturing supplies and petrochemicals. Upgraded today at Morgan Stanley to equal weight. The analyst says the company's earnings missed last week and that 31% drop in the stock price that has now reset valuations to fair value. Those shares, though, still sliding down about 2.5% on the day. And those are some of our top calls. Pleased to say that the analyst behind that last call, he joins us right now. Ravi Shanker is managing director and equity research analyst at Morgan Stanley. And Ravi, I understand that the move that you made in your rating today is partly based on that sell-off that we had last week. I want to talk about why we saw such a severe sell-off. A 30% drop in a stock is not normal under any circumstances. And I do wonder if the miss that we saw on earnings was something very specific to this owns company's operations, or whether this is much broader and we can read into something about current economic conditions.
Right. First of all, thanks for having me. So no, that's exactly it. I think the sell-off was largely triggered by fairly idiosyncratic factors, some of it related specifically to the company, some of it related specifically to the LTL trucking sector, rather than broad macro issues. Now, understandably, macro is not helpful at all, but I think the factors that drove the stock significantly higher over the last 2 years or so were very specific to this company and to the industry. You are seeing some of those expectations reset, both in terms of the multiple and numbers. That's what happened with the print last week. And that is what drove the sell-off primarily, in our view.
So take what we learned out of Saia and then put that up against what we learned out of Old Dominion Freight, another big trucking company in this space, which did beat earnings and had a much different reaction in the market.
Look, I think both of them are very good players in the LTL trucking space. I think expectations were slightly different for both stocks, and that's why the stock reactions were slightly different. But I'll also say, kind of just going back to some of your previous speakers on your show, that this has been a very, very confusing and challenging environment out there. And I think the market itself is trying to find the right set of expectations to price into some of these stocks. And some of the biggest idiosyncratic winners over the last 2 years or so, as you're trying to find our way out of this freight cycle, have been places where people have been hiding out, looking for a defensive cohort, if you will. And some of those defensive names may not be as defensive as people thought 6 or 12 months ago. And so I think what you're seeing, again, is more of a positioning-driven reset of select names relative to each other.
Ravi, if we end up importing less, even if it's just in the short term as supply chains reset or we start importing from different countries, does that not mean that there will likely be an offset from internal traffic? And wouldn't that benefit the less than truckload sector?
I think that's a great question. And I think that is an enormous TBD, which we will figure out over the next 6 months or so. I don't think you can have one-for-one replacements as we sit here. But at the same time, I think supply chains are, to an extent, living, breathing entities and will adapt to changes, whether they are externally enforced in the case of the COVID pandemic, or macroeconomic or other factors. And so we will see to the extent to which companies, global manufacturers adapt to conditions in front of them. But I think the important thing for them is to get a sense of certainty on what those conditions are, because once you have a frame of reference as to what game you're playing, then you can bring out the right playbook. So I think once we get a little more clarity over the next few months, I think we'll see the industry try to evolve.
Ravi, what kind of pricing power do these transportation companies have in a slowdown or even a recessionary environment?
The answer is a lot and none, in that transportation as a whole is a very large sector that doesn't make anything. We just move everybody else's stuff from point A to point B. And as such, it's effectively a cost center for most manufacturing companies out there. And you see a lot of the transportation costs directly passed through from the transportation companies to the manufacturers, and effectively from the manufacturers to the end consumer. So there will be an attempt to pass through any inflation in the coming months and quarters. But at the same time, it is also a very fragmented industry, particularly trucking. And so if some cohorts of the industry, maybe the mom and pops, decide to take a little more or absorb more of that cost burden without passing it on, maybe there's a little bit of share shift. But ultimately, we think that the entire transportation space will be looking to pass on these costs to their manufacturer customers.
Ravi, thank you so much for joining us today with your upgrade there on Saya. That is Morgan Stanley's Ravi Shanker. And it looks like we might just turn positive right now on the S&P 500. This is Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Bonnie Quinn.
It's kind of interesting, too, to see the price action today. You talk about a U.S. market that had been in the red for a good portion of the session, now trying to bump into the green, Bonnie.
Yeah, exactly. And we are seeing just a little bit of dollar weakness, which is interesting. One of the commentators earlier on saying that this is actually helping with earnings and obviously helping stocks, too. Could it be the same as last week, Romaine, where we had one down day followed by 3 up days?
And it's not just dollar weakness. You think about it as dollar weakness relative to what? Relative to the Swiss franc, relative to the yen, relative to the entire world, including the euro. I was just taking a look at this. The month of April,
crazy.
This might actually be the strongest month for the euro. And let me just double check my math, going back to 2010.
The appreciation has been stunning in the last 2 months. We've gone from literally 103, 102 to 115.
Keeping an eye on everything that's been going on in the currency space here on this Monday as we welcome our audiences across all of our Bloomberg television and radio platforms. A special conversation starts right now with Valdis Dombrovskis. He's the Commissioner for Economy and Productivity for the European Commission, effectively the man in charge and overseeing that trade bloc's economic policy. Great to have you here, Valdis. You are here in the United States at the New York Stock Exchange. Last week, you were down in Washington for the IMF and World Bank meetings. I know there was a big message delivered by our U.S. counterparts with regards to trade and with regards to the geopolitical conditions. I am curious about what message you brought to the table for your U.S. counterparts. What did you tell them?
Good afternoon. The main message is that we continue to engage with United States. We see United States as our strategic ally, and we have largest trade and investment relationship in the world. So we are willing to invest in this relationship, continue our cooperation, including finding negotiated solution as regards trade and tariffs.
Are there active negotiations at the high level between the EU and the United States?
Indeed, negotiations are ongoing. Also, last week I was meeting Scott Bessent in Washington, and we were also touching upon these issues. But I would say there is also still lots of ground to cover.
So what happens when you see somebody like Giorgia Meloni of Italy acting like she's been given a mandate to make some kind of a deal with the United States? Can you stop that from happening, or do you lean into it and say, well, if Italy can lead the negotiations, maybe we'll get somewhere?
First of all, it's clear that also individual EU member states like Italy and others are having their bilateral relationships with US and continue their engagement. At the same time, as regards specifically external trade is exclusive competence of European Union, so negotiated by European Commission on behalf of EU member states, and all EU member states know it and respect it, so there's no issues there.
There has been some suggestion that Europe and China are talking, and I think the idea is that perhaps you might agree to something in order to pressure the United States. Is that, or has that been happening?
As regards these US and China, well, first of all, we note that basically right now the US market is closed to Chinese goods, so tariffs are prohibitively high. And the question is, what is going to happen with all those goods which are not now reaching US market? Where they are going? Are they going, for example, to the EU market? So our message to our Chinese counterparts is that it's important also that China shows restraint, that it does not put all this now overcapacity of goods to other markets, including EU, because then we will have to react, we will have to close our market to protect our economy, our companies, and that will lead even to further global economic fragmentation. And it's in everyone's interest actually to preserve multilateral rules-based trading system.
But we have a White House here in the United States, Valdis, that is not pursuing a multilateral rules-based system. I mean, that is very clear. So how do you negotiate a deal with the United States and potentially at the same time negotiate a deal, if necessary, with China?
That's exactly the point where we think that at the end of the day, sticking to the rules, following multilateralism is going to be better for everyone. Right now, obviously, it's a fact that Trump administration has put those tariffs, including on European Union. So we are willing to negotiate. By the way, we have suspended our first set of counter tariffs, which already decided, but we also suspended them for 90 days to give those negotiations a chance. And we do hope to find a negotiated solution.
For our TV and radio audiences, we're in conversation right now with Valdis Dombrovskis, the EU Economic Affairs Commissioner, live from the NYSC. And Mr. Commissioner, I am curious as to what, if any, demands the U.S. has made with regards to what your tariffs, or effectively, or barriers, if you will, would have to be in order to get the United States to remove any potential tariffs and barriers from that side. Is this a conversation about 0 for 0 in terms of tariffs, or is there more that they're asking for?
As regards tariffs themselves, it's worth noting that actually, before the recent introduction...
Continue, Commissioner.
Yes, I'm hearing you. Before the recent introduction of those tariffs, the tariffs which EU was putting on US was a trade-weighted average of 1.2%. US tariffs on the EU trade-weighted average was 1.4%. So actually we have very low tariffs on each other. And indeed, one of the offers for EU side was to go 0 for 0 on industrial tariffs. We are also exploring possibility to buy more LNG from United States, to cooperate more in area of energy, and are willing to explore also other areas.
Does one of those other areas include the VAT tax?
Well, no, actually, that's the point, that we don't think it belongs to trade negotiations because our value-added tax is consumption tax. It's applied equally on both domestically produced and imported goods, and as such is not trade distortive. It's like similarly, US states have sales taxes, which are also consumption taxes, which are not trade distortive, and they just do not belong to trade negotiations.
Commissioner, the administration has said the first to the table will get the best deal. Are you concerned that we'll see deals from other large blocks of countries or countries, and that you might be a little bit late, that you'll get maybe worse of a deal at that point?
We don't think we are in a race here. What is important to reach agreement on substance and to find mutually acceptable solution.
What are sticking points right now?
Since those are ongoing negotiations, I cannot go into much detail. I've indicated some of the ideas which we are exploring, but as I was also saying, there is still quite a bit of ground to be covered.
I am curious, Commissioner, about the relative strength that we've seen over the last few weeks in the euro relative to the dollar, and it's got a lot of investors questioning whether that's something sustainable. What types of discussions have you had with your peers over there in Europe about capitalizing on, at least for what right now is a modest reallocation away from U.S. assets into European assets?
Well, first of all, as regards euro exchange rate, European Central Bank is not targeting the exchange rate. So exchange rate is determined by the markets, and also the level we see now is not like historical highs of euro. We had seen actually also euro at higher levels. But in any case, indeed, we see interest from investors in euro-denominated papers, and there's going to be quite a strong supply of these euro-denominated papers in this and next year. So there is going to be opportunities for investors to invest in Europe. So if investors want predictability, they want stability, respect for the rule of law, Europe is a good place to invest.
Does that include an increase in bond sales, particularly common bond sales?
Well, actually, we have a strong pipeline of bond sales due this year and next. We have close to 300 billion euros of recovery and resilience facility bonds still. We recently proposed a new common borrowing facility, safe facility for common procurement of defense equipment for member states. It's another 150 billion euros if we talk about common borrowing, but also Germany has recently announced additional 500 billion euros package to strengthen investment in infrastructure and defense. So also other countries, so as you see, there is going to be quite substantial supply also from European side.
All right, Commissioner, really appreciate you taking time for us. Valdis Dombrovskis, the Commissioner for Economy and Productivity for the European Commission. This is Bloomberg.
Boeing shares up about 2.25% now after the aircraft maker got a boost to outperform by the firm Bernstein on their growth trajectory. Adding to this, Airbus has agreed to take over some facilities from Spirit AeroSystems, clearing the path for it to be reacquired by Boeing. Joining us now to discuss all the tailwinds hitting Boeing is Bloomberg's Julie Johnsson. So, Julie, a tough road ahead, but ultimately a better outcome for Boeing with Spirit back under its wing, so to speak?
Oh, absolutely. You know, Boeing's finally starting to catch a few breaks, and this deal is key to closing one of the big issues from last year, which was the quality breakdowns in its supply chain. Spirit is one of the biggest suppliers to Boeing, also a former Boeing subsidiary. So here's a chance to bring them back into the fold.
So, I mean, what does that actually, though, mean, though? Because, I mean, we talk about this idea of loss of confidence or whatever the phrase I'm looking for here when we talk about consumers concerned about leadership. The leadership is there, and the general idea right now is that investors and for that matter, customers are actually going to be okay with the current situation?
You know, it's a new leadership team, and it's early days. So, and you know, we've learned to never say never with this industry because the shocks can come out of nowhere. But Boeing just had a really solid first quarter. Their customers are praising the progress they're seeing in the factories. And so it's trending in the right way for this company right now.
Just really briefly, Julie, how does Boeing afford this?
Oh, that's a great question. So because Boeing's been bleeding money now since 2019. They just raised $24 billion late last year with an equity sale, and they're selling one of their crown jewel assets for another 10.5 or 6 billion. And that deal was announced last week. So that gives them plenty of ammunition to go out and buy Spirit and absorb the costs that will flow from that.
All right, Julie, thank you so much. We'll be keeping an eye on the stock. That is Bloomberg's Julie Johnsson there on Boeing. And right now, the S&P 500 up 2 points. We have turned positive on the session. We're going to take you to the closing bell with Callie Cox, Chief Market Strategist with Ritzholtz Wealth Management. This is The Close on Bloomberg.
I don't think it's leave the US. The US is still the dominant market. It still encapsulates probably 70% of the MSCI All-Country World Index. So you're not going to get away from that. What I think is interesting, though, is when we have opportunities and dislocations like this, it's a chance to be able to reallocate assets out of the US and into international, because US has outperformed international for the last decade, and it's looking kind of attractive.
Angela Mwanza over at the Rockefeller Global Family Office kicked us off to the close just about 50 minutes ago. And Bonnie, it was actually quite a different sort of reading on the screen, at least when it comes to U.S. equities. When she appeared, we were in the red and now flipping into the green as we get closer to those closing bells.
Yeah, you have to wonder what causes the bounce here on days like this. I mean, obviously we're seeing the VIX go lower as a result of that as well. And earnings season has not been bad. You know, profits are up nearly 18% year on year. And maybe there's a little bit of optimism that, you know, the 20% of the S&P 500 in terms of the mega caps that are reporting this week, the Mag 7, they'll do better than forecast.
Well, we should point out most of the Mag 7 is lower. You're getting modest bids into Apple and Microsoft, but the big names like Nvidia also lower, as well as Alphabet. And you just talked about it. This is, I believe, going to be the busiest week for earnings, at least among the S&P 500 companies, something like 180 companies reporting.
Yeah, exactly. And bears repeating, though, we are only, and I say only in quotation marks, about 10% off our peak, right, in February. So when you think about it that way, we're just back into bear market territory again. So maybe things aren't so bad.
You're such an optimist. Let's see how our next guest feels about things. As we count you down to the closing bells, just about 8 minutes to go. Callie Cox joins us here in studio, Chief Market Strategist with Ritzholtz Wealth Management. And I'm going to start off on Bonnie. I was kind of teasing her. It's kind of funny that this is the silver lining, right? Is that we're only down 10%. And I guess I understand why she would say that, because it did look a couple weeks ago like we were headed for a deep bear market. A couple indices did hit bear market territory. But when you look at the four major ones now, the Russell, the Dow, the NASDAQ, and the S&P, the one I shouldn't forget.
Long day.
They're all still in correction territory, but not necessarily anywhere near bear market territory, with maybe the exception of the Russell. Are you encouraged by that?
Yeah, definitely. And I like pointing out the silver linings. I'm glad you did, Vonnie. I know it's hard to really pick out the optimistic parts here, but I think it's important to remember that we're in this phase of figuring out where the new center of gravity is, and that's not going to be the same for every stock. And you mentioned the Russell 2000. Small caps have been hammered recently, probably as they should have been, on the back of these tariff concerns. But, you know, there you have a gap, and that's when you can start evaluating, you know, what's been hit too hard and what hasn't been hit hard enough.
But that gap is interesting now, right? Because a lot of people have seen these drops in stock prices and said, okay, maybe this is a bargain. But then you still have to look at relative valuations historically. And then we're in earnings season right now, where a lot of companies are really going to have to show their cards. Obviously, the first quarter doesn't matter as much, but they're being asked about the second quarter, third quarter, and beyond. And I do wonder if investors are going to like what they hear over the next couple of weeks.
Well, that's the big question, right? And if you're an investor looking at these earnings reports, you need to look at guidance, you need to look at or listen to management commentary every season, but especially this season, because we've had a lot of change over the past quarter or so. Those Q1 numbers may not hold up into Q2, Q3, Q4. I think it's interesting that companies are pulling out different strings in how to, you know, explain what comes next. The bimodal guidance, the guidance X recession,
the bimodal stuff.
the guidance X tariffs. It reminds me that companies are strategic, so you really have to listen closely. obviously, but listen to cost of goods, listen to supply chain problems. There are some hints you can look for.
Yeah, all these CEOs and CFOs are suddenly becoming economists, on the one hand, on the other hand, but that's how the administration is sort of acting and treating. And you see it in the market. It's a very flighty market. I just want to quote Mark McCormick of the Toronto Dominion today saying market narrative half-lives are accelerating. Now, that is very scary for somebody wanting to put money at work or rotate.
And I think that's the world we live in right now. I don't think it's necessarily it's happening with the new administration's policies, but I don't think it's necessarily an indictment of the new administration. The world moves faster than ever, and as an investor, and we say this to our clients all the time, that means that you have a plan that you need to have a plan that you can stick to, right? You need to have targets, you need to have allocations, you need to understand your time frame, because to a certain extent, if you're investing for retirement, these ups and downs don't really matter. They're little blips.
Callie, what are safe havens here? Because the bond market is also extraordinarily flighty. It's repricing and repricing constantly now, right? So that's definitely a place where you might want to have just a little bit of trepidation. But is gold really a safe haven?
I think gold is interesting here. The definition of a safe haven is changing a little bit, as we've seen in market moves recently. I don't think it's changing as much as some people, but at the same time, longer-term bonds didn't work as well in April, and that spooked a lot of investors. Those are the typical portfolio parachutes. So yeah, think to gold. Gold is interesting right here, but you have to remember it might be climbing on the back of inflation worries. And if those inflation worries walk back, then suddenly long bonds and longer bonds could be interesting. I like the intermediate part of the curve. I like hedging, not quite at the 10-year, but looking into the 2 and 5 year, and holding cash as well. Cash is as secure as you get.
Well, that's what I'm curious about, too. I know a lot of people are kind of poo-pooing bonds, but if you are a long-term investor and you can lock in a certain corner of your portfolio, whatever it is now, 4% at least for the shorter end of the curve, and almost 5% on the longer end of the curve, I would think, particularly given what you could have locked in, 3 years ago, which was 0, I would assume you would see some people taking advantage of that.
Yeah, and like you said, Romain, you're not getting paid for the yield if you look down the curve. But you have to remember, a lot of people invest in bonds for different reasons. There's capital protection, there's yield. Yeah. From a yield perspective, it does look smarter to go a little shorter there. From a capital protection perspective, we're seeing more action and hedging there in the intermediate part of the curve.
When we talk about just the total portfolio allocation, and in the past you talk about this idea of being long-term, so maybe look past some of the short-term noise, there was still sort of a playbook in there that was largely about, a large weighting to U.S. stocks, assuming you're a U.S.-based person, to U.S. stocks, and then everything else was kind of centered around that. Are you seeing any case to be made for less of an allocation to U.S. assets and more to international exposure?
Well, I think you have to believe in U.S. markets. That's where we start at Ritzholtz. The U.S. has some of the most innovative companies in America, and there are piles of data showing that you need to be invested in the U.S. I'm not quite sure it's time to change those allocations quite yet. I think it's smart to be grounded in the U.S., but also to be internationally diversified, something that a lot of managers were questioning towards the end of last year. The U.S. has outperformed by a long mile. So at this point, I think it's time to talk about being a little more diversified. Is that lowering U.S. allocations? I'm not so sure. I don't think we're there yet. But, we have to remember that international was falling by the wayside, and now suddenly people are discovering it again.
All right, Callie, got to leave it there. Just you can say this on air right now. This is way more fun doing this show than being on with like Josh and Michael and those guys. Right?
Oh yeah, definitely. I'll say it to the camera. Just kidding.
All right, you can tell I'm a big fan of yours, big fan of both of theirs as well. Callie Cox is Chief Market Strategist with Ritzholtz Wealth Management. Of course, Barry Ritzholtz, friend of this show. Vani, in the green across the board right now with the NASDAQ kind of the main laggard here, but you're seeing fractional gains across the board.
There's a feeling of unease, though, I think. For all the Silver Linings playbook that I've been,
Silver Linings playbook. Never saw that movie. How was it?
I never saw it, actually. I just know Ryan Gosling is in it. But the point being that there's a lot that's going on underneath the surface. And while we got the tariff onslaught, we're now seeing the sort of slow grind of trade coming to a complete stop. Yeah, and it'll be interesting, too. We have the earnings season kind of colliding with a big economic data week as well. A full breakdown of everything starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romain Bostic here alongside Vani Quinn, taking you through the Closing Bell. It's a global simulcast, and it starts right now. Carol Masser and Tim Stenovic join us in the radio booth. Alex Seal and Scarlett Fu on assignment today as we welcome our audiences across all of our Bloomberg platforms. on a day where I guess Carol gets to smile. Carol, you love Mondays, and at least based on the market action, I guess, somebody loves it as well.
I guess so. It's really kind of quiet in general. We are definitely off our lows of the session, a little bit higher across the board, certainly better than what it looked like maybe about an hour or so ago. But I just feel like there's, Tim, kind of wait and see for all the earnings coming this week and the big drop of economic news.
Yeah, so on the economic front, certainly wait to get the jobs report on Friday. Before that, though, we get a lot of companies reporting results. We'll get Amazon and Apple and Microsoft. We'll hear from McDonald's, Coca-Cola, Meta Platforms as well, Visa, UPS, Exxon, and more. Maybe that'll be a catalyst because nothing really was a catalyst today.
Yeah, and as Romain mentioned earlier, analysts have not really been bringing down their estimates, at least for this quarter. They're still expecting profit growth of, 15% on average for the whole year 2025. I suppose other questions will be, what will they say in terms of their capex spending? Will they double down on what they've already promised, or will they be reining it in just a little bit?
I think, too, I just sort of advise all the folks who have a Bloomberg terminal. Gina Martin-Adams, who runs our equity strategy team, she had a great note out kind of previewing this earnings season and really talked about where analyst estimates were. And she talked about how they had come down for a lot of the main sectors in the S&P, with one big exception, and that was in the tech space. In fact, those estimates still relatively elevated given the big sell-off, and that could be a gap that has to be narrowed, either to the upside with earnings coming in better than expected, or to the downside with prices dropping further. On this Monday afternoon, pretty much unchanged across the board, but a big turnaround from where we were earlier in the session when stocks were deep in the red. The Dow Jones Industrial Average closing higher by 114 points, or 0.3%. The S&P higher by 3 points, or roughly about 0.1% on the day. The Nasdaq lower by 17 points, or 0.1%, and the Russell 2000 adding about 8 points, or 0.4%.
All right, to the S&P 500 I go. More names in the index, ultimately higher by the closing bell here. About 334 names in the S&P 500, Vonnie, higher. You got about 168 to the downside.
Yeah, it's really interesting because earlier, really, the only green we had on the screen was maybe energy or maybe utilities at one point in the day. Now you're seeing a lot of sectors did manage to crawl back into the green, including utilities, the best performing sector, real estate, energy, healthcare. But again, you have those laggards, and you have to wonder if they won't have an outsized effect on the market this week, and that's information technology and the likes of consumer stocks.
All right, feeling a little greedy, so I've got about 4 names I'm going to go through in terms of gainers. Boeing among them, up about 2.4% at the close. As you know, Airbus agreeing to take over some assets and sites from Spirit Aerosystems. So this essentially clears the way then for Spirit to be acquired by Boeing. We know that that was the plan, Boeing to bring back Spirit to the fold. I should point out Bernstein also upgraded Boeing to outperform, noting that the aircraft maker is now, quote, making the progress it needed for the growth trajectory. So Wall Street analysts weighing in as well. On holding, up about 3.4%. Citi raised the sneaker maker to buy from neutral, saying it's among the best positioned brands to navigate the current uncertain environment and pass on higher costs to consumers if needed. So a standout there. Peloton up more than 5%. Truist Securities upgraded the company to buy, saying the stock is finally nearing a point where the company's improving fundamentals should support a recovery in shares. Keep in mind, stock is down about 25% year to date, but down 96% from its all-time high back in January of 2021. And for something, you want to do some earnings?
Yeah, let's get to some earnings here. Cadence Designs, of course, a software company that basically used by the chip equipment sector here, reporting revenue in the most recent quarter that came in line with estimates, $1.24 billion. Adjusted EPS did beat $1.57. The street on average was looking for $1.50. And get this, the company actually says it's going to raise its 2025 revenue and EPS outlook. It says revenue will now be in a range of $5.15 to $5.23 billion. Now, that's only slightly above what the street was looking for. Like, we're talking like a few $100,000 here. The EPS, 6.73 to 6.83. The street was looking for 6.65 to 6.75. So I guess a modest vote of confidence here, both in terms of the quarter that just passed and the year up ahead, Carol and Tim. The company actually raising its guidance.
I think that's kind of interesting. Made me look at the supply chain function on the Bloomberg. So Huawei, IBM, LG Electronics, some of its biggest customers. So it makes you wonder, okay, maybe there's some demand for their products and maybe what it says about those businesses. Hey, one last gainer I just want to get to. Ticker is CGON, CG Oncology, and it's about a $2.2 billion market cap cancer drug developer, soaring today, up 25%. Company came out and gave some data for a late-stage trial of its experimental experimental therapy for bladder cancer. So some upbeat news there. And so that one was soaring in today's session. Tim, what do you got?
I got some stocks that were in the red today. I do want to start with shares of NVIDIA. They fell today by 2%, but they were down as much as 4.5% earlier in the session. They were under pressure after this story in the Wall Street Journal that Huawei is getting ready to test a new and powerful AI processor to rival NVIDIA's. We're going to be speaking with Kunjan Sabani just a little bit about what that looks like in just a few minutes. Also on our Markets Live blog, kind of a cautious sign, they note, at the start of a busy week when 4 of the Mag 7 are set to report earnings. Spotify shares down today by 3.7%. The company, though, has been on an absolute tear. They do report earnings tomorrow. This year, shares are up more than 30%. Last year, they were up 170%. The year before that, up 150%. We did learn today that Spotify paid out more than $100 million to podcast publishers and podcasters worldwide in the first quarter of 2025. But keep an eye out for those earnings to cross tomorrow before the bell. And finally, Roper Technologies industrial manufacturing fell today by 1%. This after the company reported first quarter results and gave an outlook for adjusted second quarter earnings that came in below expectations.
In the yield space, a relatively quiet day both in terms of volume and volatility, but you did see yields drop across the board. Remember, it's been about 3 weeks now where we've seen yields, particularly on the short end, start to drift lower, and that continued to start this week as well. 7 basis points on the shorter end of the curve. That's your 2-year yield, 3.68 and change right now. On the longer end of the curve, your 10-year yield down about 3 basis points, and your 30-year down about 2.
All right, guys, let's get to some of the individual stories that kind of caught our attention today. And
what caught your attention, Carol?
I don't know about you guys, and I don't know about you, Romaine, if you've been playing around with ChatGPT, but Tim and I are kind of obsessed and playing around with it. And apparently OpenAI is going to let users actually go shopping with ChatGPT, kind of a head-on challenge to Google. It's a limited number of categories, but they're going to start letting us all play
shopping?
around.
Like
so you can... Yeah, you can basically shop for a product, and it's going to take you basically to something that will show you where you can find that particular product.
People have already been doing that.
Yeah, so let me get this straight. So all this trillions of dollars being poured into AI and all this other stuff, and the net result of it is that, what, I can shop?
That's not the only thing you can do, Romaine.
Well, Bonnie, you seem...
It's another service.
Yeah.
Now, we're not at the stage where the robot shops for you.
I was told this was going to change my life.
Okay.
I did.
Wake me up when the robot's there.
I did a little experiment over the weekend. I did ask it to compare some prices for a certain product online. I was buying some new contact lenses over the weekend.
Whoa.
And I asked for the cheapest ones, and it came back.
Cheapest ones.
Was it good?
No, it wasn't accurate.
Oh.
Yeah, I found a better deal somewhere else.
Just one example.
Using an old-fashioned web browser. I do use ChatGPT for a lot of stuff, but
tell them what you did with your son.
So my son's learning how to read. And he gets like a book a week from school that it's really short. And I wanted to find other books that were sort of similar at that reading skill level. And I just asked ChatGPT to write a little story that features characters that are, named after his friends. And it can do that in seconds. And it's something fun that he can do and sort of read along. And it's like a nice, fun way for him to practice reading.
That is very sweet.
Cool.
Although you could have made the story up yourself, Tim, if
you know what you should do, Tim? If you really want to impress him tonight, you should read him at bedtime. There was a letter out by Colonel Archibald Gracie.
No.
Okay.
He was actually a passenger on the Titanic.
Okay.
You remember the Titanic, right?
I do,
and I'm not talking about the movie. I'm talking about the actual ship all the way back there in the early 1900s. April 10th, 1912. That was the first day he was on the ship. It set sail for Southampton, England. And he wrote a letter that was sort of unintentionally ominous, basically saying, hey, it's a fine ship, but I shall await my journey's end before I pass judgment on her. That letter just recently went to auction, and it sold for about $400,000 US.
We'll FaceTime you and have you read the letter.
Okay, sure. I'm sure your son would love that.
But he survived until towards the end of the year. He was never able to fully recover from the cold that he had experienced. But I'd love to know, did he write a letter after he got off, passing the judgment and saying what he thought?
Yeah, right?
Dark. Sorry.
No, go there. If you think about what he said ahead of time.
Thanks, Carol. That's really insightful.
It's a Monday. Leave me alone. All right, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals.
Far,
go play
wherever you are. I believe.
Wow.
And my heart will go on.
Wow. What happened
Hope
to
we
you?
have the rights to that.
Did you have a really good weekend or something?
I did, Carol Master.
That was touching.
Thank you. That's why I'm here.
All right, that'll do it. We'll see you again, same time, same place tomorrow.
And our coverage continues here on Bloomberg Television, a conversation about treasuries, a conversation about commodities, and a conversation with the man who was the first to link the yield curve inversions to recessions. He's got a new paper out on gold, and you want to hear what he has to say. Cam Harvey joining us after the break. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Bonnie Quinn.
And I'm Romaine Bostic. Another interesting day on Wall Street. I guess interesting if you like watching paint dry. We came into today with some questions as to whether last week's rally would extend into this week. It looked like we were going to close in the red, but we did get a modest bump as we got closer to the close. And S&P 500 fractionally higher on the day. You saw a little bit more strength in the Russell 2000. What you did not necessarily see is strength in the big tech space. In fact, the NASDAQ effectively closed down on the day, only by about 0.1%. But that's significant because remember, we are heading into a big week where we get 4 of those Max 7 names set to report this week. You see that kind of reflected in the Philadelphia Semiconductor Index today, Bonnie, which was down about 0.4%. Whether that's something idiosyncratic or whether it's a harbinger of what we're going to learn over the next few days remains to be seen.
Exactly. And I think investors are looking for any signs from anywhere, from even the earnings that come out this week, what's going to happen with all of those semi stocks, right? Particularly Nvidia, which was down 4.5% at one point in the session, climbing back to just down 2.1%. Obviously, there's the Wall Street Journal report, but there's also just the sentiment and the trepidation about what's going to happen with all of these stocks. In aftermarket trading, it actually crawled back to zero, so unchanged on the session. Boeing up to about a 2.4%. We know that it's getting a little bit of relief. Airbus is buying some of the Spirit Aerosystems assets, and that will allow Boeing to reacquire Spirit Aerosystems, which should help with some of its mechanical problems and so on. And then I thought I'd point to AbbVie again, because while for most of the market we had a reversal of what happened on Friday, stocks like Tesla, for example, gave up some gains early in the going. A stock like AbbVie continues its gains. Obviously, earnings weren't the most amazing, but in its pipeline, it does have a wrinkle drug that's coming out, for example, and that is cheering investors. Hard to come by stocks that are higher in this space, but AbbVie up 3.4%, one of the best performers in the S&P today.
Yeah, nice roundup of what's going on in the equity space. Let's broaden this out and talk about some of the asset classes out there. And that is our top story of the hour. It's that search for haven assets. For weeks now, investors have been moving money out of the riskier corners of the market and into the relative safety of things like ultra-short treasuries, European stocks, the Japanese yen, and even gold. In fact, it was a week ago today that spot gold closed at a record high. A bet that the metal's historically low correlation with stocks and its perception as an inflation hedge offered the best port in the storm. As spot prices have rallied almost 30% to start the year, you heard that right. Exchange-traded funds tracking gold, they've seen inflows in 8 of the past 10 weeks. The GLD Spider Gold Shares ETF, that's now sitting on $100 billion of assets, its most ever, and now makes it the 12th largest ETF in the United States. However, our next guest says that while gold can protect your portfolio from market chaos, it's not without its own unique set of risks. Cam Harvey has spent his career studying market risk, most notably for his research into the yield curve and its correlation with economic conditions. He has a new paper out on what's been driving gold higher over the past few months and whether gold's reputation as a hedge actually aligns with reality. Bonnie?
Yeah, Romaine, Cam Harvey, Director of Research at Research Affiliates, joins us now. So, Cam, explain to us, please, what is the problem with gold here? It would seem like all the textbooks are saying that what's happening right now should be happening. What is the problem with this?
So, think of it this way. There's 2 groups of buyers for gold right now. And if we look at gold, this is not just a recent phenomena. Over the last year, it's up by over a third. So what is going on? So on one hand, you've got people today that are questioning whether the U.S. dollar will be the reserve currency of the future. And given the risk in the U.S. has increased, that means that those people those institutions, those central banks are diversifying their portfolio. So that means they're selling dollars and buying something else. And if you want to buy something that is perceived as safe, that's gold. The second group of people are those that actually want a replacement of the US dollar as the reserve currency. So think of Russia and China. They do not want to be reliant upon the dollar. China has been actively buying gold over the last couple of years. And this is further increasing the pressure on the price.
So this gets to this idea, though, Cam. If we can't sort of look to this as a hedge or as a safe haven, at least in the more traditional sense, is there an idea that there is something else out there that can fill that role?
Yeah, so most people don't understand that gold is a volatile asset. And think of the dynamics of the supply and demand of gold. So sometimes demand increases for a good, and you just increase production. But gold's production is very sticky. Mm-hmm. So last year, 3,300 metric tons were produced, and that's not that much different than what we've had in the past. So a small increase in demand could have a large impact on the price. And indeed, that's what we've seen. But the thing that's really important here is that gold is as volatile as investing in the S&P 500. And we know that we can have large swings in the S&P 500 value up and down. So in that respect, gold, even though it's relatively uncorrelated with the stock market, given the volatility of gold, it can be very unreliable as a hedge.
We'll talk about this because I thought it was interesting in your paper, and I think there was a previous paper you did a few years back that kind of talked about gold from a historical basis, meaning the idea of, okay, how much of protection or a hedge or whatever you will does it provide over certain periods of time? And it was like almost like you had to go back hundreds or maybe even thousands of years, you can correct me if I'm wrong, to really sort of chart that outperformance. Explain that.
Yeah, so in this paper, we did this fascinating experiment where we found out what the wage of Roman centurions were. So the Romans had very detailed records. So we actually got the weight in gold of their wage and then compared that to the wage of an army captain in the U.S. and found that it was pretty similar. And what that means is that gold's price in terms of a real, so inflation-adjusted gold is relatively constant through time. So it does provide an inflation hedge. But this is key. I said that it's as volatile as the S&P 500. So to get that hedging ability, the horizon is very long. So it's not 5 years, it's not 10 years, it's centuries or even millennia. So again, we need to be very careful here because of the volatility of gold can lead to a situation where it fails to provide that hedge.
So, Cam, how do you know how much of a premium you want from gold then? Or how do you even know what a premium is? At one point, it might have been heresy to compare Bitcoin and gold, but just in terms of the valuation question, you could ask the same question. How do you value an ounce of gold or a Bitcoin?
Yeah, so in my research with CloudHerb, we actually draw the analogy of the real price of gold. So the idea, if we inflation adjust gold, and we do show that gold holds its value through time. So the real return on gold is zero, which means it holds its value. So it moves with inflation over very long periods of time. But again, if you think about that, we draw the analogy to a price-earnings ratio for a stock. So if the price-earnings ratio is really high, then when you look at future returns, those returns are often low. And we do the same thing with the inflation-adjusted price of gold. So we look at the inflation-adjusted price and look at the real return on gold over the next 10 years. And historically, that has been low or negative. So investors beware. Right now, there's a lot of momentum investors in the market. And if you look at the historical record, at least, in points of time where that real price of gold is at an all-time high, then the empirical evidence, at least in my research, suggests that the average returns over the next period are low or negative.
Fascinating look back and fascinating paper once again out of you, Cam, and really you and everyone over there at Research Affiliates always really providing real context for investors. Cam Harvey is Director of Research over at Research Affiliates. We do have some breaking news now. This on the semiconductor, NXP Semiconductors. They're out with earnings, but the real headline is a new CEO. They have said that the current CEO, Kyver, is set to step down at the end of 2025. They have named his replacement, Rafael Sotomayor, who basically runs the secure edge business, will assume that role by October, the end of October of 2025. The company did also report earnings, a modest beat on the bottom line, a modest beat on the top line with $2.84 billion in revenue in the most recent quarter. The company, though, did provide a guidance that might have caused some concerns. It said 2Q EPS will come in a range of $1.78 to $2.16. The street was looking for $2.05 on average. The company also saying that revenue in the current quarter, the second quarter, will be in the $2.8 to $3 billion range here. The bottom end of that range is slightly below the average of analyst estimates. Bonnie?
Will remain coming up a tight election race in Canada. We'll break down the latest on the ground. That's coming up next. This is The Close on Bloomberg.
Let's turn our attention to Canada, where voting is closing out in the final hours. Prime Minister Mark Carney looking to lead the country's Liberal Party to victory against his Conservative challenger, Pierre Poilievre. Joining us right now to discuss is Bloomberg's David Gura, who is there in Quebec, Ottawa, in the background. All right, David, let's talk about this. I mean, this has been an election unlike the U.S. elections, which is kind of packed away pretty quickly here. Give us a sense here as to what the main issue is. Is this a referendum on Carney, on Poilievre, or is this a referendum on Donald Trump?
Well, it's a great question. Picking up on what you said, this has been a blissfully short election cycle compared to the kind that we have in the United States. But what started out as an election that was really centering on the economy here in Canada, focusing on housing, for instance, or debts and deficits, or inflation, has really turned into a referendum on how each of these leading candidates would deal with Donald Trump, the President of the United States, who has made, as you know, threats not only on the kind of long-standing economic and trading relationship between Canada and the United States, but on this country's sovereignty as well. So both of these candidates in recent weeks have really hit upon that point, trying to present themselves as the ones who could go to the White House, make the case for Canada, push back on the rhetoric and positions of President Trump, basically fight him on what he's been saying on those issues of trade and sovereignty. You look at Mark Carney, technocrat, longtime central banker, of course, the head of the Bank of Canada, followed by the Bank of England. He's presenting himself as somebody with experience on top of that ability to go toe-to-toe with Donald Trump. Pierre Poilievre is presenting himself as a change candidate, somebody who is saying, look, the Liberals have been in power here for about 10 years. It is time for a change. Mark Carney would just be an extension of Justin Trudeau's prime ministership. We'll see which of those two viewpoints is resonant with voters here as they finish up going to the polls. They're expected to close here in the next few hours or man.
And of course, David, Canada, a federation, right? So how unified are the various provinces?
You know, it's really fascinating to see sort of how the campaigning has played out. So as we look at when these ballots will be counted, so many of the seats in Parliament are centered around where I'm standing in provinces here in the east of this country. But the West has been a very contested part of this race as well. And Prime Minister Carney was there over the weekend campaigning in those provinces, trying to get those votes as well. And then again, this speaks to the way that he's presenting himself here, not as a career politician, but somebody who is really trying to win all of Canada, because he, like Pierre Poilievre, thinks the way to send that unified message to President Trump as they begin to talk about trade policies is by trying to get as much support from this country as possible. So just kind of parsing the public opinion polls, there are some differences. Pierre Poilievre is younger. He enjoys more support among young Canadians. Pierre Poilievre is from the western part of this country. He's doing well in that part of Canada. You look at Mark Carney, he's catering or doing well with an older part of this population, and again, doing better, Vonnie, with folks who live in the eastern part of Canada.
Can't wait for the updates throughout the evening and into the night, David. Thank you so much. That is Bloomberg's David Gura. And of course, the Canadian dollar has been pretty volatile, but trading at 138.20 today. It's weaker by just a few millicents, if you like, Romain.
All right, when we come back, Bonnie, we're going to take a look at the state of the movie sequel. I don't know if you're a movie buff, but there's been a key milestone in Hollywood's evolution on this day in history. That was when Avengers Endgame had the first $1 billion box office weekend. We discuss when we come back, right here on The Close. All right, let's take a look back at this day in history. 2019, when the superhero movie Avengers Endgame became the first film to take in more than $1 billion in ticket revenue in its opening weekend alone. Now, that milestone had been years in the making as Hollywood executives embraced the financial power of sequels rather than new original storylines. Now, while it was a gift to the bottom lines of Hollywood studios, they were often derided as a crutch, a sign that Hollywood had lost its creativity, a loss that some say would lead to sequel fatigue among audience hungering for something newer and fresher. Now, the new Ryan Coogler film, Sinners, has been a proxy for that conversation as of late. It's one of the few original studio releases to top the box office charts in ages and is now the 5th highest grossing film of the year. In fact, the only one on that list that's not a sequel or part of a previous series. However, for all the derision of sequels, they have been a financial saver for Hollywood, either straight-up sequels like Inside Out 2 or serials franchise films like the Marvel movies, or even films based on long-standing IP like Barbie. The top 10 films last year each fell into one of those 3 buckets, and 15 of the 20 highest-grossing films of all time also fall into those categories as well. And the trend is far from new. Hollywood's first sequel, that was actually all the way back in 1916, a follow-up to D.W. Griffith's controversial Birth of a Nation. Then you had the Thin Man franchise films of the 1930s, the campy sci-fi sequels of the 1950s, like Revenge of the Creature from the Black Lagoon, and then the mega blockbuster extensions in the 1970s, 80s, like Godfather Part 2 and Indiana Jones. This year, as a percentage of all movies slated for release, sequels will dominate the calendar more so than ever. A year that has already raked in $2.2 billion in ticket sales. That's up 12% from the same stretch last year. So if you're a studio exec or you run a theater chain, that has to be music to your ears, no matter whether the storyline is a retread of movies past or something original like Sinners. Bonnie?
Exactly. Well, we have the perfect guest because on that note, we're lucky enough to have the CEO of IMAX who joins us now, Richard Gelfond. And thank you so much for joining. So, Rich, first of all, congratulations on Sinners. How expensive are these IMAX movies to make, IMAX cameras?
Actually, it's not that much more expensive when you look at the kinds of budgets we're talking about. So we have 2 kinds of movies that we film with cameras. With digital cameras, it's not a lot more expensive. But films like Sinners, where you use IMAX film cameras, you know, it depends how much you film, but it's in the low millions of dollars.
Everybody was talking about it this morning, and Romain, I know you haven't seen it. I haven't either. Apparently, I should because there's a lot of Irish content.
I plan to go this weekend.
But moving from the US to China, how much are you filming in China? Because one of your other great successes this year in China was Ne Zha 2.
Yeah, so we use the digital cameras in China, which are the ones that I've said don't cost a lot more. And maybe we have 5 or 6 movies filmed with the cameras. Just to make it clear, though, if they're not filmed with the cameras, we could also use algorithms to digitally remaster them. So they don't have to be filmed with the cameras. But if they're filmed with the cameras, they have a special look and feel that really stands out, like Oppenheimer did in 2023.
Well, the look and feel is impressive. And I do wonder about greater adoption of the format. And I know you have certain directors like Coogler. We were talking off camera about Chris Nolan, who clearly love it. Are you going to see more directors embrace this, or is it just kind of just those that, I guess, have the artistic kind of, sensibilities to use it?
I think there will be more who embrace it. And one of the reasons is we've invested in more cameras. So we built, there's a limited supply of them. So you couldn't do more than 1 movie at a time. But now you can use IMAX film cameras for multiple movies at the same time. So there's Chris Nolan's filming The Odyssey, which is his big epic for 2026. There are a number of other films we haven't announced yet that are also using the film cameras. But I think the demand is so high. It came up on Bloomberg Terminals today and the Wall Street Journal that how far people will travel to see an IMAX film. So it's an extra thing. And you know, in your intro, you talked a little bit about the power of sequels. So films like Nolan has done or Sinners, they don't have IP that draws people in. But I think knowing they were filmed with IMAX cameras creates something special about them and creates a built-in audience from the start. Cinemaphiles, and then what happened with Sinners was after Cinemaphiles and Rotten Tomatoes validated how great the film was, it broadened out into a bigger audience.
I am curious about global audiences, particularly given that we're in a weird time here in the United States where we're kind of battling it out on the trade front with every country in the world. I know China was a big market for U.S. content, whether it's films or music or anything else here. Are you worried at all about the relationship between the U.S. and China and that could affect demand for our products?
You know, I'm not really worried about demand in the movie industry because I think China, with the limits on exports or higher costs for exports, I think they need to focus on their domestic economy. And films are one way the Chinese get people to go to malls and shopping and get people up to prime the pump domestically. And as you mentioned about Naja a few minutes ago, that film in China has done 2.2 billions of dollars. So many billions, I'm getting confused.
A lot more people.
But that's by far the biggest movie they've ever had there. So I think there still will be an appetite. Of course, you never know where these things go.
Yeah.
Well, I mean, China is rejecting U.S. content right now, right? So what kind of a partnership do you have with China in terms of making domestically Chinese content?
China is not rejecting content right now. As a matter of fact, this weekend, Thunderbolts opens in China, which is a Marvel film. And Lilo and Stitch just got admitted to China. It's kind of business as usual. I think there's a false narrative that movies are impacted, but they're not. I think what's impacted is tariffs, and those are on goods, not on services. So as I said, you never know where something goes, but it's not having any impact.
But you're not worried about maybe movies themselves just becoming kind of a political football, that if China wanted to retaliate against the U.S., they say, okay, you're not going to be able to show your Marvel movie or whatever here.
Well, I mean, I think it's such a small number in the, you know, versus soybeans and other things. I'm not worried about it. As I said, it couldn't be more business as usual right now.
Obviously, there is going to be a Hollywood task force, right? How to sort of make Hollywood great again. And I'm curious as to how much business you actually do in Hollywood these days, given that it's apparently not as hospitable to the movie industry itself anymore.
Well, about 80% of our global box office is Hollywood films. The other 20% is local language films or concerts or
But they're not
alternative
filmed
language.
in Hollywood, right, anymore? They're filmed in other states that are more...
They're filmed all over the world, but from our consumers' proposition, you know, consumer doesn't care. Sinners was filmed in Georgia. Look at the way people are responding. You know, it's been a long time since Hollywood was the place films were made, but I don't think that affects the consumer proposition at all.
I am curious about overall demand. I know we've seen people rush to the box office in recent weeks because you have had some really good films come out here. Do you see a long-term trend of theatrical viewership, meaning people going out out on a night and seeing a movie, that is on an uptrend?
Well, when you talk about this year, 2025, the slate is unbelievably good.
Yeah.
So, as I said, you have Thunderbolts coming out now. Shortly after is Mission Impossible 8, which is the last in the series. There's How to Train...
It won't be the last in the series.
Well, I have an inside line to Tom Cruise, and he says it's going to be the last.
We got to talk afterwards.
I take your point. But then you have a Formula One movie with Brad Pitt. As I said, How to Train Your Dragon. And then as the year goes by, well, you have Jurassic World coming out soon. You've got, at the end of the year, Avatar. You have Wicked 2. There's an awful lot of good films. And then next year, as I said, you have Odyssey, you have Star Wars, you have Despicable Me. There's a lot of really good films.
So you sound like you're pretty bullish on where the industry's going.
Well, we've projected that our box office would be 20%, roughly 20% better than our best year this year, or 1.2 billion. So we are bullish.
All right. Well, you're
Tom Cruise and Brad Pitt for you right there, yeah.
All right, Richard Gelfond, the CEO of IMAX. All right, Bonnie, let's take a quick look at how the markets close on the day. The action was not much. Volume still light, but that could change in a big way over the next few days with 180 companies in the S&P 500 reporting, including those big tech names.
Yeah, it's fascinating. I mean, if you look at the Philly Semiconductor Index down 0.4%. But remember, we have these big swings in this market. Remember, Tesla was up 10% on Friday or Main, and at one point today it was down 4% plus. So you just never know.
We're seeing a modest drop in yields on the day. The VIX pretty much unchanged. Bitcoin getting a modest bid as well. Stick with us. A lot more coming up here on The Close. This is Bloomberg. All right, we talked about 180 companies in the S&P 500 reporting this week, and that includes Starbucks. The coffee chain set to report results tomorrow, and investors are expecting a drop in sales on weakening consumer sentiment. Shelly Banjo joins us right now, our managing editor for Global Business in the Americas. Now, no one was expecting a great quarter, and I know they got a relatively new CEO who's still trying to sort things out here. But is there any sort of expectation that we will see some articulation of growth?
I think anything that's better than terrible is going to be good for them tomorrow, because Chipotle came out and said, you know, we're going to be hit with tariffs. All the other companies are saying we're going to be hit with tariffs. Starbucks has the double whammy of coffee prices, egg prices. So if it's anything short than terrible, I think people will be okay.
What are people looking for? Do they think they're going to withdraw their guidance or just not say too much about it in order to ease nerves?
Yeah, I mean, that's what we've been seeing with a lot of these companies. Most of them are actually getting rewarded by the market when they cut guidance, because it does seem to signal to investors that, hey, we're actually taking this pretty seriously and that we are going to do something about it, cut back, manage for this time.
All right, Shelly, well, thank you so much. Shelly Banjo is going to keep an eye on those Starbucks earnings and will report back to us tomorrow. And it's not just Starbucks reporting, Romain.
Yeah, you got a slew of companies in the fast food and fast casual space reporting this week. That includes McDonald's, it includes Shake Shack. And we're really looking here at Bloomberg for any kind of light, some insights that we get onto the health of the consumer, particularly with prices elevated and now tariffs on the map. Of course, it's not just the big fast food chains as well, even just, well, good old-fashioned regular dining, some of those more upscale diners. Let's bring in someone who knows a lot about that. His name is Ben Leventhal. You might know him because he worked, of course, at Resy, helped to found Resy, and is now the founder and CEO of a company called Blackbird. He runs a restaurant loyalty program, and he joins us now here in Studio 2. Great to see you.
Great to be here.
All right, you founded Resy. That goes sold off to Amex. Now you got this partnership with Amex and your new company, Blackbird. Just kind of explain how this works. So when I hear loyalty program, I was like, huh? But so the general idea here is that I download your app. If I go into one of the participating restaurants that you have a relationship with, I just tap my phone, and essentially whatever I buy gets charged to my account, and at some point I get some sort of rewards back. Is that how it works?
You have it right. I mean, we're focusing on rewards, access, and experience at the restaurants that are on our platform. The fundamental idea is the more you dine out, the more you dine at restaurants and patronize the restaurants on our platform, the better that experience should be.
What is the market for that? And I ask that because me and my wife always joke, I mean, living in New York City, that we rarely go to the same restaurant twice because there's just so many to choose from. We're like, oh, we can go there again, or we can try something new. So how do you factor that trend in?
You should try as many new restaurants as you want. Yeah. Some of those are hard to get into. Others of those are your neighborhood joints. Look, we think the independent restaurant industry around the world has got some problems right now. If you look at the industry over the last 20 years, you see a massive decline in profit margins. Yeah. Your favorite restaurant, my favorite restaurant, it's operating on its best day at a couple of points of profit margin. Yeah. That has to change. We think fundamentally that's about how big companies have come to sit in between restaurants and their customers. So at the end of the day, we're trying to disintermediate that relationship between restaurants and guests and reward both sides for it happening.
But there's another layer to this, right? So I can pay $6.99 a month or $75 a year, so I'm essentially giving you some revenue. But you're also on the blockchain and you may be minting in my wallet, and I don't understand why I would want you to mint in my wallet or how I get paid for that.
All right, so a lot of ideas there. So we are not charging for access to our platform. The more you use the platform, the more points you earn, the more the experiences get better and better and better, the more access you have. There's things you can do to load into our system if you want to skip the line for access and things like that. But fundamentally, the idea is you actually shouldn't have to pay to play. Now, what we're doing on chain is two big things. One is we're thinking about your identity as a customer, and two is we're thinking about how the network, the payments network, functions. In terms of identity, the core idea and the thing that the blockchain allows us to do is transfer ownership of your information from us, Blackbird, to you, the customer. And so when you are dining at our restaurants, when you check in using our hardware, we essentially create a digital handshake for you between you and the restaurant. And from that point forward, the restaurant has you as a customer. It understands your dining history. It understands the things that you like, your preferences, the other places that you've been, and has essentially a high fidelity view of you as a guest. So the blockchain allows us to do that. The other thing that the blockchain allows us to do is it allows us to create a payments network that has participants as owners of the network. Now, this is a long-term idea, of course, and in the short term, we're focused on moving value from you, the consumer, to the restaurant. But in the long run, some of the fundamental concepts that the blockchain has brought to the forefront are going to allow us to build a network where restaurants are co-owners with us.
So I understand that, hospitality has been moving into the future a little bit with, lots of things on blockchain now.
Ever so slowly.
Yeah, ever so slowly. And I'm wondering about chef proprietors, for example. How do you get them on board? Because ultimately, does a high-end diner really want to say, by the way, I'm paying, with Blackbird? It feels almost like a Groupon, right, Romain? Or something a little bit maybe not as chic as just credit card.
Blackbird in a restaurant is very simple. You check in, you put your phone in your pocket, and then you get up and leave when you're done. So we think that's actually a very high-end experience. Now, obviously, in QSR and fast casual settings, there's something that feels a little bit more transactional. But what we think about Blackbird is it's old school hospitality powered by new school tech. And so no matter where you go, that's really the core of the experience. Easy, frictionless, incredibly high hospitality.
Well, one thing I'm interested in, Ben, and in your previous comment, it almost sounds like to a certain extent, if you're a restaurant and you're partnering with Blackbird, are you effectively cutting out, I guess, the middleman, meaning the payment middleman, the credit card processor? Are they out of the equation if they're using the app?
Well, we're giving them an alternative. Yeah. I mean, I think on the consumer side, we understand how much people love their credit cards, their Amex Platinum, their Chase, whatever it is. And so, we don't have any illusions about what it's going to take to get this to work for restaurants. So today on the consumer side, you can use whatever you like, and you can vault that into Blackbird and pay like you would without Blackbird. The restaurant gets another option. So when consumers are transacting using Blackbird, their fees are lower, their access to data and loyalty tooling is obviously much higher. And so we think in the long run that's a good solution.
So a lower fee than whatever they're being charged through the regular platforms or the credit card companies. And that includes like lower than, say, a Square or a Toast or something like that as well. It does. You also bring up this idea of having some control over data, which a lot of companies don't, particularly if you're dealing with the straight credit card processor. You don't even get to see that data. What types of data does the restaurant get from you when I'm using your app?
You're going to get the basics of who you are as a customer, obviously. First name, last name, a way to get in touch with you. We've added dining history to that. We have a proprietary scoring system that essentially gives the restaurant an idea of your potential value. We're giving them tools that give them visibility into how you spend, where you spend, why you spend, under where you live, in terms of your home neighborhood. A bunch of things that we think signal to the restaurant the kind of how they should think about you as a customer.
Talk to us about down the road, an eventual exit or an eventual payback for A16Z and some of these great investors. You've raised what, 84 million, but that's
85,
85, but that's for Resi as well as Eater, right? Or
that's
just
85 for Blackbird.
For just Blackbird,
over
okay.
3 rounds.
So what's going to happen with all of these individual entities?
Listen, my job is to build the company and to think about tomorrow.
Oh, come on, you know.
We want to build an incredible company. We want to be in every restaurant on the planet. We think that is the future for the restaurant industry and will be a bright future for us. Whether that outcome means us being an independent company for a long time or finding some partner in the future, we'll find out together.
Well, you've created lots of success already with your other entities, so well done.
All right, Ben, thanks for being here. Ben Leventhal is the founder and CEO of the restaurant rewards app Blackbird, and of course also the founder of the restaurant reservation site Resy. We'll be back in a moment right here on The Close as we set you up for what to watch over the next 24 hours. Stick with us. This is Bloomberg. All right, let's push ahead to what the market's going to have their eyes on over the next 24 hours. And Vonnie, it is a lot of earnings. Let's start in the pre-market. Before the bell opens, we're going to hear from some big names, including General Motors and UPS.
And what's interesting about this, and the markets will have all day to digest these earnings and these comments from CEOs and CFOs before we get the aftermarket earnings. But we get so many areas of the economy reporting tomorrow, right? You have the transports, UPS, GM obviously will have something to say about what's coming down the pike. We just spoke about Starbucks, and then Coca-Cola is a consumer discretionary.
I think the Coca-Cola thing could be interesting as well, because we talk about this idea of international exposure. And then I was taking a look. Don't forget, we have JetBlue is also reporting, and we know there's been a lot of concerns about travel. And I'm also keeping an eye, it's not on there though, but Spotify reports as well. And just in terms of potential volatility, that's the one stock that I think everybody's looking at, an up or down move based on options pricing of as much as 10%.
Fascinating. Yep. And also, as you say, Hilton, Royal Caribbean, the tourism stocks as well. Where are we seeing the shifts in tourism?
Yeah, and then when we get to aftermarket, that's when we get sort of another cross-section there. It's also booking, so that gets into travel and airlines, Caesars as well. I don't know if you're a big gambler or not, Vonnie.
I'm not going to say.
Okay. We get Mondelez, we get Starbucks.
You don't have $50 on you by any chance, do you?
I don't. Okay. We get Visa, and then Snap, another company that could actually move a lot. I was looking at the options pricing on that, something like 19% move up or down, depending on what that company says.
Yeah, and you know investors are going to be looking for anything that these companies say on tariffs and on AI as well. Does that narrative come back? Mm-hmm. In a big way tomorrow?
Absolutely. So that's the pre-market earnings as well as the post-market earnings. In between all that, and in fact, at about 5:30 a.m. Eastern time, the Norway Wealth Fund's annual investment conference takes place in Oslo, and they got a special guest.
Got a special guest who just got paid. That shareholder vote went through, and David Solomon got his full pay package, so he'll be a happy customer, I'm sure.
We're also going to get the Conference Board's consumer confidence number as well as JOLTS data. We'll have full coverage of all of that stuff right here on Bloomberg Television, starting first thing in the morning with our crew at Surveillance and ending, of course, with us and Balance of Power. This is Bloomberg.